Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you're new here and enjoyed today's video, be sure to hit like and subscribe to the channel so that you can see more videos in the future. So today what we're going to talk about is something that is basically accepted as fact across a large percentage of the sort of financial community, and that is that diversification is king. So I want to argue some points against this and run you through why some of the best investors in the world do not diversify their portfolios, and possibly run you through some sort of flaws in people's thinking when it comes to diversification in the stock market versus diversification in other areas of investment such as real estate and that sort of thing. So let's get into it. This is always a bit of a controversial topic, so can hear your thoughts down in the comments below, but for now let's get into it. So before I dive into my own personal opinions on diversification and why I tend to be fairly anti-diversification in the stock market, I want to show you this quick clip from Warren Buffett and Charlie Munger. It's about a minute or so long, and this was taken from their 2008 Berkshire Hathaway shareholders meeting. So check this one out.
Charlie and I have been confident enough, if we were only running our own net worth, I'm certain a very significant number of times, if you go over 50 years, there have been a lot of times when you'd have put at least 75% of your net worth into an idea, aren't there, Charlie?
Well, but 75% of your worth outside Berkshire has never been a very significant amount.
Well, but I'm going back. Let's just assume it was. Let's just assume you didn't have Berkshire in the picture. There have been times, I mean, we've seen all kinds of ideas we would have put 75% of our net worth in.
Warren, there have been times in my life when I've had more than 100% of my net worth invested in things.
That's because you had a friendly banker and I didn't. No, there have been times, well, initially I had several times I had 75% of my net worth in one situation. There are situations you will see, over a long period of time. I mean, you will see things that it would be a mistake if you're working with smaller sums. It would be a mistake not to have half your net worth in. I mean, you really do sometimes in securities see things that are lead pipe cinches, and you're not going to see them often, and they're not going to be talking about them on television or anything of the sort. But there will be some extraordinary things happen in a lifetime where you can put 75% of your net worth or something like that in a given situation.
So there you have it. Warren Buffett and Charlie Munger would be quite comfortable in their personal portfolios putting 75% or more of their net worth into one position that they felt very confident on, and that they had a high level of conviction on the return that they were going to get from that investment. And Warren Buffett actually later on in that meeting describes not investing a large percentage of your net worth as actually being a mistake when those situations come along. So I'm going to run you through some examples of investors that I follow outside of Warren Buffett and Charlie Munger that also preach concentrated portfolios and that sort of diversification is a bad idea if you know what you're doing. And I'll run you through some reasons why, and some kind of strange reasons why people don't like diversification for whatever reason in the stock market generally. So there's a series of investors that I tend to follow, and you've heard me mention a lot of them on the channel before. So Warren Buffett and Charlie Munger are right at the top of the list. They are the people that I get a lot of inspiration from in terms of developing an investment strategy and looking for, things to pick up in companies. The other ones that are on that list are Phil Town. Then you have Monis Prabrai, you have Guy Spier, you have the likes of Phil Fisher, Lee Lu. All these guys are quite famous value investors. Peter Lynch, I'll put on that one as well. Quite famous value investors. Peter Lynch and Phil Fisher are a little bit more on the growth investor side, but they definitely still pay attention to value. And pretty much all of them run with extremely concentrated portfolios, with the exception of probably Peter Lynch, who owned a ton of stocks. Pretty much all of those investors that I mentioned will tend to have at least 50% of their portfolios in their top 3 or 4 or 5 positions. Warren Buffett has slowly kind of gotten away from that over time just because of the sheer scale he's working with now. So he's got investments that he made in the 60s that he just made such a massive capital gain on that he's not going to sell and move that into new investments. So he's still got those sort of legacy positions on, I suppose. But, even in the last couple of years, we've seen Warren Buffett put 25% of his stock market portfolio into one single company, which is Apple. And so firstly, I think it's good to look at the argument from the other side around why you would want to diversify your portfolio. And basically the reason is to manage risk. If you don't know what to look for in a business, if you don't know how to value a business, if you don't know how to figure out what sort of return you can expect from a business, then how can you confidently put a large amount of money into that stock or into that business? Because that's what we're buying at the end of the day. We're buying small pieces of ownership in companies when we buy shares in the stock market. So if you don't know how to do all of those things, then you have no choice but to diversify. You have to spread yourself widely across an index, whether that be something like the New Zealand Top 50 index here in New Zealand, or the S&P 500 index over in the States, or the All Ordinaries or something like that in Australia. You really have no choice but to do that. And what you are actually doing when you diversify across that broad index and that broad range of companies is you're essentially betting on that country to be more profitable and more prosperous in 10 or 20 or 30 or 40 years time than it is today. So you're expecting New Zealand to be generating more cash and have its businesses be more valuable in the future than they are today. You're expecting the same with Australia or the US or India or wherever you choose to invest. So that's the reason you might want to diversify in the stock market, is if you want to take that more passive approach, not do the intensive research on individual stocks. There's a couple of things that guarantees. It guarantees that you're going to get a market rate of return, which for most people is great. It also guarantees that you're not going to underperform the market dramatically, which again is one of the big reasons why people diversify. But it also guarantees that you're 100% sure to not outperform the market. You're not going to get rich a lot quicker than the average investor in the market and that sort of thing. So that is why when you know what you're doing, you shouldn't diversify. And we see people run with very concentrated investments all the time outside of the stock market. I'm sure that you know people who have close to 100% of their net worth in a rental property, or close to 100% of their net worth in their own home, or close to 100% of their net worth in a farm. People run with very concentrated portfolios, and often when you say that to people, they sort of hadn't quite connected the dots between being concentrated in a real asset that you can go outside and see versus something that people often think of as a symbol that goes up and down with the stock market. And that's not what stocks are. They are businesses. You are buying into a piece of that business. And if you are just as confident about the future performance of that business as you are about the future performance of a farm, or the income you're going to get for a rental property and the expenses that are going to be on that rental property, if you're just as confident about either of those situations, and you're seeing that, in the stock A, I'm going to be able to get a 15% return even with a big margin of safety, versus the index where I'm going to get maybe 5 or 6 or 7%, why would you not put a whole heap of money into that 15% or 20% return option rather than putting it into the 6 or 7% option? That's basically what you want to do in stocks. When you get these phenomenal opportunities come across your desk, or come into your world, you want to put as much money as possible into those opportunities. Another way to put that is that here in New Zealand you can buy a personal home to live in with 20% down. So in other words, you can go into an investment that will have massively negative cash flow with 500% of your net worth, yet people still hesitate to put 10% of their net worth into an investment that has hugely positive cash flow and will generate massive returns in the future. So, 500% of your net worth losing a whole bunch of money versus 10% of your net worth with massive upside and quite small downside if you're buying with a margin of safety. And that sounds extremely backwards to me. So that's one of my main arguments against diversification, and one of the reasons why I think when a great idea comes along, you should have a high level of conviction if it's a business you understand, if it has a competitive advantage, if it has great management, and you can buy it at a really discounted price. And this is one of the reasons that Monash Pabrai and Phil Town and those people like I mentioned, they will often have only 3 or 4 or 5 stocks in their entire portfolio. They'll be very concentrated, they'll be making big bets, they'll be making fairly infrequent bets, and they'll be looking to hold these companies for a long period of time. But they want to make the most out of the opportunities that do come along. If you own 40 or 50 stocks, what are the chances that you're going to like stock number 49 just as much as you like stock number 1? And what are the chances that the returns on stock 38 are going to be as good as the returns on stock 2 or 3? So if you're able to actually work through those figures in your head and understand the business and figure out what sort of returns are likely to happen in the future, you should put a lot of money into those big ideas, and if you're correct, you're going to benefit massively from that long term, and you're going to speed up the rate of compounding. So that's a few thoughts on diversification. I just want to get into a couple more points, and then I'll leave you today. So my last point around diversification is it's actually quite a cool filter that you can use when you're looking for potential investments from other famous investors. So when you look through the 13F filings from other investors, you can see the companies and the size of the positions that each of these investors own. So you can go ahead and look at what Monash Pabrai owns, and what Berkshire Hathaway owns, and what Charlie Munger owns, and what Li Lu owns, and all these things. As long as they're managing more than $100 million US, then they're going to have to declare quarterly what they own and what sort of positions they hold. So using diversification as sort of a filter on which investors to follow, I've found that to be a really beneficial tool. So if you come across an investor, let's say they go on CNBC or something and they say that they're buying Facebook stock, then what you want to do is, if you agree with a lot of their points and that sort of thing on Facebook stock, and it prompts you to do a bit more research, then you're going to want to go over to their 13F and have a look at, what's their sort of level of conviction on Facebook. So if you go across to their 13F and you see that they've got 30% of their portfolio on Facebook, then you're going to know that they have a very high level of conviction on that position, and they're probably a value investor. They're not going to be speculating on price with that level of concentration. They're going to have valued Facebook. They think it's available at a margin of safety, so they've put a large chunk of their net worth in it, a large chunk of their investors' net worth in it, and they expect it to generate very, very high returns. Unfortunately, what you'll often see is when these people on CNBC come and, boast about positions that they're investing in and how great these companies are, oftentimes you'll go across to their 13F and you'll see that Joe Blogs has 1.5% of his portfolio on Facebook. And that is not a high level of conviction, and that is probably not a value investor. Value investors know when good opportunities come along, and they know that good opportunities are rare. So they're going to put a large chunk of their net worth into those positions when they do come up. They're not the types of people to run with 1 or 2 or 3% positions. Monash will pretty much never have a position smaller than about 10%. You'll see Warren Buffett has a few bits and pieces of companies, but when he's buying heavily, it's generally at least sort of a 10% position in the portfolio. And in his personal portfolio, this may be 80 or 90 or 100% like he was just saying in that clip before. So that's a good little filter I use on looking through 13Fs. I really only look at investors that are, have their sort of top 5 positions make up north of 50% of their portfolios. So that's a quick tip, and I hope you get a few benefits out of that one. So those are my thoughts on diversification. I'm really keen to hear your thoughts in the comment section below as well. As I say, this is always a bit of a controversial one. In my opinion, if you know what you're doing and you can confidently predict the performance of a business, just like you can confidently predict the performance of a rental property you might be looking at down the street, you shouldn't, approach those investments any differently in terms of the amount of money you put towards them. So you wouldn't put 1% of your net worth towards a rental property unless you were obscenely rich. You wouldn't go into partnership with a whole bunch of other people just to buy that house if you knew it was a really good deal. Just like you shouldn't spread your money super widely if you've only got 3 or 4 good options at any one point in time. So those are my thoughts. Hope you enjoyed the video. You can hit subscribe over there if you did and you want to see future videos as well. And you can watch some other content that I've done over that way. So have a great day. Cheers.